Okay, so here's the third and final accounting concept that we're covering in this series. As in my previous video, I've said that there are three accounting concepts that all business owners should know, to some extent at least. We've covered two of them in other videos, and this is the third and final concept that we're going to cover. So, just as a sort of a recap, these are the three accounting concepts. So the first one is the accounting equation: assets minus liabilities equals equity. There's a separate video on that. Double entry accounting: for every debit there must be a credit, which is the reason why the accounting equation works. So check out the video on that. And then this one, which is the Accrual Accounting Convention, which, as I've said in another video, the key difference between the three: the first two are all about numerical accuracy. This one is about the accuracy of timing, which in the context of, I always bang on about how the correct calculation of profit in a given period is vital for performance valuation and making decisions in your business. So the timing is absolutely vital for that. Not only is it, it's a requirement anyway under accounting standards and in order to correctly calculate your tax bill, but that's not the driving factor for me. It's about calculating the profit correctly for the period so that you can make decisions taking you to the next period. So this is traditionally the one that people struggle with the most if they haven't got a financial or accounting background. So we're going to go through a couple of examples just to hammer the point home. But to start with, let's just look at the concept itself. So, as I said, the concepts we've covered so far in the other videos are about numerical accuracy. This one is about timing. So the official definition of the Accrual Accounting Convention is it's an accounting system that tries to match the recognition of revenues earned with the expenses incurred in generating those revenues. Now that's a bit long-winded, but essentially what it means is that if you generate some revenue, then whatever costs were incurred in the generation of that revenue should be recognised in the same period as the revenue. So that's not really much better in terms of long-windedness, but I think it's a bit clearer than the official definition. So the important thing which people consistently struggle to understand when we go through this is that it's nothing to do with payment. Because obviously you get credit terms from your suppliers, you might give credit terms to your customers. You need to try and forget that there is anything. Well, you need to forget anything to do with payments, right? Payments is cash flow. This is about the correct calculation of profit in a period. So the reason that's important is because you might get 120 days credit on your from your supplier, but you only give your customer 30 days credit. So let's say you buy something from your supplier and you don't have to pay for it for 4 months. Then you sell it to your customer and you get the revenue within 30 days. So there's no correlation whatsoever in terms of timing between the money coming in and the money going out. So if you were to report on the basis of cash in and cash out, you would be reflecting profits from revenue from 1 month and costs from potentially 3 months ago. And there'd be massive disparities in your profit calculation. So you'd end up paying the wrong amount of tax. You'd have no basis for decision making because the profit you're making is nothing like what profit you're actually making. So it's nothing to do with cash flow, nothing to do with payments in or payments out. It's all about recognising the cost of the whatever it is you're selling in the same period as the sale takes place, essentially. So I hope that makes sense. Obviously, you can always reach out to us for a better explanation, or do one of our training courses, or buy my book. So let's go through a couple of examples. So the first one of that. Now, the Accrual Accounting Convention obviously needs a mechanism by which it moves things from a timing point of view. So if, let's say you have a cost in this month, but you've not had the invoice for it yet, because in normal terms, you would get an invoice with a date on it. And you post that invoice to your accounting system, and that's when that invoice from your supplier is recognised. So if you get, let's say you buy some stock in January, and you get invoiced for it in January, you post that invoice to your accounting system, and your system basically recognise, if you ran a P&L or any kind of report at that point, it would say you've spent X amount of money on stock in January, because that's the date on the invoice. And that's how accounting systems work. If you then sold that in February, you raise the invoice to your customer, dated, let's say, the 3rd of February, your accounting system will record that as a sale in February. Now, both of those are correct, and from a, so let's say, a VAT point of view, that's how it should be, because that's the recognition of that's the tax point on the invoice, is the date. So that's when the VAT is recognised, and it's also when the revenue or cost is recognised in the accounting system. But what we need to do in terms of to abide by the Accrual Accounting Convention and to record the correct profit in a given period, we need to move one of those into the same period as the other. And 9 times out of 10, it's the cost that you're going to move. There are some specific examples where you would defer a sales invoice or accrue revenue from the sales invoice, but in most cases, it's the cost that you're going to move. So the mechanisms for doing that is an accrual or a prepayment. They're opposites of each other. So if you've got an invoice, let's say you've got a rent invoice and it's for the next 3 months, because that is how a lot of commercial properties work. So you get an invoice in January, but it's actually for January, February and March. So what you would do is prepay 2/3 of that invoice. But basically, it makes logical sense though. If this invoice is for 3 months of rent, then you don't want to recognise, let's say it's £3,000, £1,000 a month. You don't want to put £3,000 in January and then nothing in February and March, because that is going to understate it's overstating your profit in 2 months and understating your profit in 1 month. So what you need to do is end up with £1,000 in each. So don't worry about the accounting movements. That's for your accountant or your finance manager or whatever. That's for them to worry about. But the principle is all you need to be aware of, that you should not see, if you get given a P&L for the first quarter of the year and it shows £3,000 for rent in 1 month in January and nothing for the other 2, then your accountant hasn't done their job, or your finance manager or whatever has not done their job properly, and this is it. You need to challenge them on that and get it moved. So the opposite of a prepayment is an accrual. So this would be, for example, where let's say you've got a bill, you know you've incurred a cost in the month, but the supplier wants to wait until the 15th of the following month before they invoice you for it. An example of this from in my experience is eBay fees. So we've worked with e-commerce sellers that sell on eBay, and eBay do their invoices on the 15th of the month to cover part of the previous month. So you have to accrue what you think the cost is going to be. So for example, in January, you've sold a bunch of stuff on eBay, you're not going to get the invoice, you're not going to know what the costs of that was until the 15th of February. But you don't want to delay your management accounts, so you have to accrue that cost into January. Again, don't worry about the mechanics of how you do that in your accounting system. That's not for you to worry about, but it's just about understanding the principle of it, which is logical and makes sense, hopefully. So let's look at a couple of examples which will hopefully help it to make sense. So this first example is the prepayment of an insurance invoice. So in this example, this this company has started out in January 21. This is their first year. So because it's the first year, they didn't bother with insurance for the first 3 months because they didn't know how things were going to pan out. They get to April and they think, right, we better get some insurance in place now because this business has got legs. So they get an invoice for £12,000 for their annual insurance. That's the key point here. That's for the whole year. And not only that, but that year, it's not for January to December, which is their trading year. It's from 1st of April until the 31st of March next year, because they waited until April to get the insurance. So now they've insured it for a year. They've got a £12,000 invoice. And that's paid as soon as it lands. So as I said earlier, it's nothing to do with when it's paid, right? That invoice is paid in April, fine, no problem. So if you look at the profit figures at the bottom here, you got profit, 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 and then a big loss in April, and then profit, profit, profit for the rest of the year. So obviously, based on what I've said in this video earlier, that's not correct. You know, there's nearly a £9,000 loss there. And we know it's not correct because we know that this insurance relates to the entire year, not just April. So what we've showed at the end of the year then is £34,000 net profit, which is what your tax bill will be based on. It's what you'll base your decisions on for next year. And of course, this is a simple example. There's 8 or 9 lines here of expenses. But in a complex business, there could be 30 different categories here. And this is just one of them. If there's multiple similar examples, then this profit figure here would be completely wrong. So let's look at what should have happened with this, right? So the fact that there's nothing here is fine because there was no insurance policy in place in January, February and March. But from April onwards, we're insured. And the cost of that insurance is, if you split it over the year, £1,000 a month. So first thing you'll notice is we no longer have, if you go back to the previous slide, we were recognising a cost of £12,000 for insurance in the year. We've now got a cost of £9,000 in the year, which is correct because it's £1,000 a month for 9 months. The other £3,000 relates to next year, January, February, March 2022. So it's correct that we're only recognising £9,000 for the year. So we've now, instead of making £34,000 profit, we've now made £37,000 profit. So HMRC will be happy we're recognising the correct profit and therefore tax, and we now can make more accurate decisions because we've got the correct profit figure. So that's how prepayments work. The fact that that's gone into next year is fine. The cost actually relates to next year, so that's where it should sit. And again, if you think about the wording of the Accrual Accounting Convention, the cost should be recognised in the same month as the revenue, which is what we're doing here, because we weren't insured here, so there's no need to recognise any insurance cost. But we're only able to generate this revenue because we've got insurance. And so the revenue here is backed by £1,000 worth of insurance here, and that's the same every month. So banging 12 grand in there is not correct. So I hope that makes sense. So that's a prepayment. The opposite of a prepayment, as I've said, is an accrual. So in this case, we're going to look at another example. It's fairly similar actually, because it's all about the timing of expenses in a given period. So in this example here, we've got electricity cost here, 600, 400, etc. And then when we get to May, it's 0. And then in June, it's nearly double what it would normally be. So it's fairly simple. It's fairly obvious to see what's happened here. We've doubled up here because the bill came in late. So basically, the electricity bill for May, came in June and was posted into June's accounts. So that could have been a mistake. It could have been somebody typed the wrong date when they were putting it in. It could be that it arrived after this period was closed off in the accounting period and the accounting system. There's a couple of reasons why that could have happened, but ultimately, that's what's happened. So what we need to do is move whatever portion of this 1042 relates to May, we need to move it back into May. Now that's not such a big deal as the previous example, because it's all within the same year, so the profit would be correct and there would be no tax implications. But that is, as far as I'm concerned, a secondary consideration. More important is the correct calculation of profit, so you can make the right decisions to drive your business forward and accurately evaluate your performance. But actually, if you look over here, the same thing has happened in December. So it has actually impacted the year-end profit, because we're showing 40 grand here in terms of profit, but we've missed out some cost. And as I said in the previous example, this is a relatively small set of expenses. In a bigger company, you would expect there to be a lot more lines in this, and there could be others that have been missed as well. So this is something you need to get right. So if we look at how it should have been done, there's 464 in there now instead of 0, and there's 570 in there instead of 0. So we now have everything where it should be, and we're showing, it's not a massive difference, but the correct amount of profit for the year. So tax will be correct, decision making will be accurate, and everybody's happy. So this is, as I've said, this is a bit more of a tricky concept than some of the others. It does take a bit of getting your head around, because it's not really, most people think in cash terms, accountants think in terms of timing of revenue recognition and the recognition of related costs. And this is fundamentally one of the biggest reasons why, when we look at the 2060 rule, if you've seen that in our other videos, the reason why the accounts that you get from your accountant 9 months after the year ends don't match to what you thought you did in that same period. This is one of the main reasons why, because your accountant will move things around, put them into previous years or subsequent years because of the Accrual Accounting Convention. So if you understand it, firstly, you'll understand what your accountant's given you, but more importantly, there'll be less of a difference between what you think you did and what your accountant says you did. You'll actually be able to challenge your accountant if you understand this properly, because accountants do have to make assumptions on certain things. They do have to, sometimes abide by accounting standards rather than what you tell them to do. Whereas if you get this under your belt and get your head around it, you'll be able to challenge them, and your accounts will be more accurate for it. So I hope this all makes sense. Any questions, obviously reach out to us, and we'll do what we can to help.